Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Joe Malandrino, and joining me on the desk at the Nasdaq Market Site is Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, and Rob Arnott, Chairman of Research Affiliates. We're here to discuss the upside of getting dumped. Love the theme of this panel. Welcome to Trade Talks, guys. Before we get into the theme of being dumped and some more specific items here, let's talk about the macro environment. I just got back after 2 weeks on the road in Asia.
I'm jealous.
There's quite a lot to catch up on, especially when you think about different perspectives looking, to the U.S. in. Really, it's been quite the remarkable run over the past couple of weeks.
It's been a great run. You had a very quick and conclusive election outcome, which definitely helped the market, took a lot of stress out of the marketplace. And then that was followed immediately by the FOMC with a 25-point basis cut. So you're seeing a little bit more normalization there. The markets like it. The expectation is with the Trump trade moving forward that you're going to see a little bit more deregulation. The Fed is cooperating by moving to a lower benchmark. Expectations are another 25 basis point cut in December, which is also on the right track. You're seeing inflation normalize. Interest rates, like I said, are working the way down. So for companies, that works out very well for a lot of them. If you do get down to the 3.5% by next year, that could add 3 to 4% to the S&P 500 EPS, which could be a very nice boost to the bottom line there.
Yeah, I mean, even just to hit 6,000.
Yeah.
This week alone, it was really quite remarkable, and I think perhaps more volatility was expected to be in the market versus than what actually played out. And to remove that one key piece of uncertainty, having a definitive winner, a concession
and
there,
House and Senate,
right? So it just feels like, I don't want to say, not sigh of relief. We're not a political show here, but to remove that one big piece of uncertainty is a sigh of relief at the end of the day for the markets.
Yeah. We did a paper about 8 weeks ago on politics, the election in the markets. And one thing that a lot of people are surprised at the strength of the rally. Pardon me, it happened in 2020, it happened in 2016, it happened in 2012. It happens anytime that there's a close, contentious election where there's not a financial crisis. And the simple reason for that is both sides are terrified that the other side's going to win. Some of them are terrified enough to get out of the market. And one side or the other is pleased at the outcome and buys back in. So this happens again and again. It's one of those few things where odds are about 80% that stocks from a week before an election to 4 to 6 weeks after an election are up an average of 5 to 8%.
It's a great supply and demand at the end of the day.
Yeah.
And here we are.
Here we are.
Exactly at that point.
Yep.
We've got a couple of questions from a couple of issuers today on the desk.
I was just going to ask you. Yeah.
Like calling, why is my stock down today? I go, have you seen the run you've had over the last week and a half? I go, you're trading, within a lob wedge of all-time highs or 52-week highs. A pause is not a bad thing. And if you want to look at the countermeasures, the VIX, that unwinding of that fear trade, is still trading with a 14 handle. So the markets are down a little bit. The VIX is down a little bit. The dollar's up, Bitcoin's up, gold's up, the counter trade's there. It's just a pause. People just not going to trade in a straight line.
I mean, you're not going to go up 1,000 points every week. That just doesn't work like that.
Why not?
It's not.
Well, it would be nice. I'd be living on the island of Jill and not, hoofing it into Times Square every day. But I mean, that's a good point that you make, where you kind of, have to rationalize the move that you've had.
You look at the small caps. So the small caps have been beaten up year over year, especially since the interest rates, topped at 5.25 to 5.5%. Those cash burn companies, which is 40% of the Russell 2000, the cost of capital to keep your business running is just way too expensive. And if you had to raise capital in that environment over the last couple of years, you've done it in a very short-term fashion. 1 year, it might have got expensive. You might have had to issue warrants on top of it, putting an overhang. Now that interest rates are starting to come down, the Russell had a great year this past week. It was up almost 11%. It's down about 1.5% today. But if you look at the chart of the Russell, we look at a number of different things on the desk. One of the charts we look at, one of the factors in it is the relative strength index, or RSI. It measures the buying and selling of the underlying asset. And the Russell in the run last week had an RSI of over 75. For
Russell 2000.
The Russell 2000. And that's an overbought condition, meaning that it's just moving too far, too fast. It's pulled back a little. Now that RSI is in the high 60s, which is still elevated, but not overbought. That's the pause you're looking for. So if you don't want to chase and you're looking for a pullback, that's something to consider right there.
Yeah. And it's interesting, Rob, you wrote a piece in August of this year, the upside of getting dumped. And
Yes.
it's, you know what, breaking up is hard to do. That's true in the markets, it's true in finance. Tell us the premise behind this piece here.
Well, we've all had the experience of getting dumped, or almost everybody has had the experience of getting dumped, and you can wallow in self-pity for life, or you can choose to learn from the experience, grow from the experience, and move on. The same thing happens with companies. Companies are added to the S&P or the Russell and then are dumped. And when a company gets dumped, what happens? Firstly, why is it dumped? Because it's tumbled in price. Its performance has been dreadful. It's no longer in the 500 or 1,000 largest companies by market cap. Its valuation multiples are in the basement. And what a great time to buy. And so we've done a lot of work over the years on S&P additions and deletions and Russell additions and deletions. The additions are almost always frothy growth stocks trading at premium multiples. Some go on to be the next NVIDIA or the next Tesla. Most don't. Most fall short of expectations, and many of those fall right back off the index. We've seen that again and again and again. The companies that the companies that are added, most of them don't perform terribly well, so that the average actually underperforms the index by a couple percent for the first 2-3 years. All right, that's not a big enough margin to be highly profitable. Deletions outperform by an average of 28% over the next 5 years. That's 5% a year excess return. So why do they perform so well? Firstly, they're small cap, so you get the size effect. Secondly, they're deep value, so you have the value effect. Thirdly, they've had dreadful performance for 3 to 5 years, so you have long horizon mean reversion. And fourthly, the short-term momentum is poor, which ostensibly works badly for you, but with a half-life of only 3 months. Over the next 5 years, they do great. And so we created the Next Index back in June to track the performance of companies that fall out of the top 500 and out of the top 1,000, filtering out the likely value traps by taking out the companies that are either have poor financial quality metrics or have been in free fall.
See, and that's interesting because it sounds almost counterintuitive to me. You would think if you're removed from the index because you're doing, poorly, that fundamentally there is an issue. And you would think those stocks are going in by the virtue of having, fund managers having to index to these names. I was surprised to see the stats where the inverse actually is true.
And I like to joke that some of the companies getting deleted regain their footing and perform brilliantly, and others go on to achieve great failure.
Yeah.
But if you have 2 stocks and one of them depressed goes on to double, and the other depressed goes on to deserve being depressed and falls in half, that 2-stock portfolio is up 25%. Well, that's roughly what happens. You find that some stocks rebound handily, but because they're very cheap to begin with, the rebound can be large. Others sputter and wheeze and perform disappointingly. And put the two together, and that portfolio of deletions beats the markets that the broad market by an average of 28% over the first 5 years after deletion. So it starts out about 7% a year and then peters out, but 5% a year for the first 5 years, that's a big incremental return. And so we created the index to allow people to capture that. ETF Architects launched the next ETF here on Nasdaq, and it's only been about 9 weeks and it's already got about 35 million AUM. So that doesn't move the needle for jumbo institutions, and it's small by our standards. We run 160 billion total, but the 35 million in the first few weeks of a brand new product is not bad.
I think it's good too, especially considering the environment that you're going into, where there is some uncertainty in the market, where perhaps people were on the sidelines until they see how interest rate policy played out. We got that cut. What happened with the election? And Chris, we talk about this all the time with the small caps, where rates are, depending on how the dollar moves or with rates going down, that was really the thesis behind it. And then you saw how, there's when the ones with the companies where the fundamentals really mattered, regardless of interest rates, those are the ones that continue to perform well.
and continue to perform.
Right, and you see that play out with
will
the small caps
outperform
all
here.
the time.
It does, and just take a look at the S&P Mid Cap Index, a perfect example of companies in between that niche. They're not quite a $20 billion company, but they're not small by any measures, 8, 9, 10 billion. That index made a new high as well. So I'm interested in the next, though. That's very interesting because here at Nasdaq we have an index team, and they do a fair amount of index.
I've heard that.
Once or twice.
We have
An index team, believe it or not. And we cover some of the larger names here as well as the smaller names, and they recalibrate constantly. And a lot of the companies that we've been tracking, especially for me on the consumer side, have been moved out of the Nasdaq 100, but now some of them are looking to go back in 3-4 years down the road. To your point with your index.
There's a beautiful example of that. Dillard Department Store. It's been a member of the Russell 1000 4 times in the last 30 years. It's been kicked out 4 times, re-entered 3 times. The last time it was kicked out was 2017. It's up 550% since then. I mean, it got crushed during the pandemic, and it's now up 550% from when it got kicked out. If I do my math correctly, they're going to be re-added next June for a 5th time. Lumen Technologies recently struck a deal just weeks ago with Meta, and to help Meta get back to the forefront on AI. Now, Lumen was kicked out of the S&P March of 2023, kicked out of the Russell 1000 in June of 2023, and in the last 12 months it's up 500%. Okay, we launched the next index in June. 150 stocks that have been kicked out of the top 500 and out of the top 1,000. 150 stocks equally weighted. So each stock was 0.7%. Lumen's now 2.5% position. It's the largest holding in the portfolio. And it's the largest holding because it has soared. It can cover up for a lot of companies that kind of sputter and wheeze. And so this is just a niche, fun idea, deeply contrarian, deep value, small cap stocks. Anything that's kicked out of the index is going to be small cap. Anything that's kicked out is going to be deep value. And so it's a deep value, small cap portfolio that has the added kicker of stocks having been hammered down by being kicked out.
So back to the methodology for a moment here. Does every deletion go in, or do you pick stocks among those deletions?
It is an index, so it's rules-based.
Right.
But 2 of those rules are if the stock is in the bottom quartile based on our quality metrics, which include things like debt equity ratio, debt coverage ratios, profit margins. If it's in the bottom quartile of quality, we don't include it. If it's in the bottom quartile by momentum, if it's in free fall, we don't include it. Now we might include it a year later if it passes those filters. The other thing is if it's readmitted. Lumen's likely to be readmitted. Dillard is likely to be readmitted. And if it's readmitted, then it comes back out of our index because it's no longer a deletion.
Yeah, which is such an interesting strategy because sometimes there's such a proliferation of
It's
like large cap strategies going around.
It's a nice deep value look, partially actively managed. It sounds a little bit to me like, but not really because of the rules base. So you
It's
get to pick and
Because it's an index.
Right. So it's pick and choose, but it's nice to see that because you see a lot of companies, to your point, that are profitable, but just not as profitable as they were 2-3 years ago taking
And
the
they
beat.
have the possibility to learn from being dumped and better themselves.
Right.
That was my next question to you too. Again, this might be a little bit existential, but because they were removed from the index, does that perhaps take away some of the investor relations pressure so they can focus on operation metrics? I mean, I'm not sure if that's quantifiable, but...
Or their management gets kicked out and replaced with somebody competent.
So, I mean,
Which that does often happen.
Yeah,
I'm
it does.
thinking of a couple of companies right now that's just happened to in the last couple of weeks.
And like I said, about half of the companies in the next index don't outperform the market, but the ones that do outperform by enough to cover the ills of the other. And so you get this bifurcation that's really quite lovely. It's our company is involved in developing strategies and products, and we're best known for RAFI, the fundamental index. Got 150 billion, give or take, of assets in that, and this little thing is 35 million. But it's a fun niche strategy that addresses a I was shocked that nobody had launched a strategy to pick up on what indexes kick out decades ago.
Yeah.
And to find that it's still virgin territory
Yeah.
is
Well,
fun.
I mean, think about the value.
It sounds great.
You know,
actually.
the fundamental value. Like Maddie should cover small caps, right? Like,
Right,
This
somebody on
is
our team.
this is yeah, you know, this is like a you know, a really niche piece that can change your
You know,
or
when you
give you
deal-
additional point of view.
When you talk with the IROs and management team of companies that are being removed from major indexes, it's always like a shocker, or they're nervous. What do we say? One of the things we talked to them on the advisory side is, you know, you're taking away 2 to 4% of your shareholder base from passive investment. Now you're going to have potentially 2 to 4% of active investors, which is going to make your day more busier, which means you get to talk to people who actually want to buy the stock for the stock's sake.
Yeah.
And that's where the conversation begins.
That's really interesting. And when it comes to big indexes like S&P owns about 25% of the market cap of every stock in the index. S&P indexers do. And the result is that when a stock gets added, 25% of its total market cap has to be bought by the index funds, typically in one fell swoop at the end of the day that it's admitted in a single market on close block trade. And that enormous trade, who are they buying from? They're buying from active managers who love the company because it's performed brilliantly. So they have to pay a premium. And when they kick a stock out, they have to sell 25% of the total market cap of the stock. Who do they sell to? Active managers who hate the company because it's been dreadful. And so they have to push the price down to a point where people are willing to buy.
That's where the 4D chess comes in. That's interesting. All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.